Preparing for a JBS FP&A Analyst interview, you've reached Candy Mentor and this video is for you. We'll walk through 15 key questions you're likely to face. For each question, you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What does FP&A contribute to a business like JBS? FP&A turns operational data into forward-looking decisions. At JBS, I would partner with operations, procurement, commercial, and finance to build budgets, refresh forecasts, explain variances, and identify actions. For example, if feed costs rise, I would separate volume, price, mix, and FX effects, then quantify the margin impact. The best analysis ends with a clear owner, timing, and decision, not just a spreadsheet. That makes finance a practical business partner. While answering, focus on translating operational data into forecasts, partnering with procurement and commercial teams, explaining performance drivers, supporting decisions, and linking analysis to profitability, cash flow, and accountability. Question 2. How would you build an annual budget for a protein business? I would begin with a driver-based model rather than simply applying a percentage to last year. I would gather volume and pricing assumptions by business, estimate livestock, feed, labor, energy, freight, and overhead costs, then incorporate FX and planned capital expenditure. Each assumption should have an accountable owner and documented source. After consolidating the submissions, I would stress test margins, reconcile to financial statements, and present key sensitivities for management approval. Make sure to cover operating drivers such as volumes, prices, livestock or feed costs, labor, energy, freight, foreign exchange, capital spending, assumptions ownership, bottom-up inputs, and senior management challenge sessions. Question 3. Walk me through your approach to a monthly forecast update. My monthly forecast process starts by loading validated actuals and comparing year-to-date results with the prior forecast and budget. I then update remaining period assumptions using current volumes, pricing, costs, FX, and known commercial or operational events. I would meet stakeholders to challenge changes, quantify risks and opportunities, and reconcile the revised outlook to the income statement and cash flow. Finally, I would document assumptions, lock the version, and explain the bridge clearly. In your answer, talk about actuals loading, run rate analysis, updated business assumptions, forecast versus budget reconciliation, risks and opportunities, cross-functional review, version control, and communicating a concise management narrative. Question 4. How would you analyze a gross margin decline at JBS? I would decompose the margin change into price, volume, mix, input costs, yield, manufacturing efficiency, freight, and FX. Suppose revenue increased but gross margin fell. I would test whether lower value product mix, weaker pricing, higher livestock costs, or production losses caused the decline. I would compare actual performance with standards in prior periods, validate the drivers with operations, and quantify actions such as repricing, yield improvement, sourcing changes, or production reallocation. Be sure to mention price-volume mix analysis, commodity and livestock costs, yield, plant efficiency, freight, FX, customer or product mix, timing effects, and converting findings into specific corrective actions. Question 5. What is the difference between a budget, forecast, and long-range plan? A budget is an approved operating target, usually set for the next fiscal year, against which performance and accountability are measured. A forecast is a regularly updated estimate of what is now expected, incorporating actual results and changed assumptions. A long-range plan looks further ahead and connects strategy, capacity, capital investment, and growth. I would keep the definitions clear because each serves a different decision: control, prediction, or strategic resource allocation. While answering, distinguish purpose, timing, flexibility, level of detail, and accountability for each tool, while explaining how actual results flow into forecasts and how long-range plans guide strategic decisions. Question 6. Tell me about a time you explained a difficult variance to non-finance stakeholders. In a previous role, a business unit missed its monthly margin target, and the initial reaction blamed pricing. I rebuilt the variance using price, volume, mix, and cost bridges, showing that an unfavorable product mix and temporary freight charges were the main drivers. I presented the findings with a simple chart, confirmed them with sales and operations, and recommended customer-level pricing and shipment changes. The team accepted the analysis because it connected numbers to controllable actions. In your answer, use a concise star structure, describe how you simplified the financial issue, show collaboration and quantified impact, and finish with the decision or operational action that followed. Question 7. How would you forecast commodity or feed cost volatility? I would combine market data, procurement intelligence, historical cost relationships, and current inventory or contract coverage. Because price changes may flow through production with a delay, I would model the timing separately from the market movement. I would create base, upside, and downside cases, showing the effect on cost per unit, gross margin, EBITDA, and cash flow. I would also identify pricing pass-through or hedging assumptions and clearly label uncertainty rather than presenting one false precision number. Make sure to cover market indicators, historical relationships, procurement input, scenario ranges, hedging assumptions, timing lags, pass-through pricing, sensitivity analysis, and transparent communication of uncertainty. Question 8. How do foreign exchange movements affect JBS's financial planning? FX affects both reported results and underlying economics. I would map each business's revenue, costs, debt, and cash flows by currency, then distinguish transaction exposure from translation effects. For example, a weaker local currency may improve translated export revenue but increase imported input costs or debt service. I would show reported and constant currency views, run sensitivities, incorporate approved hedging assumptions, and explain the resulting effects on margin, EBITDA, cash flow, and leverage. In your answer, discuss transaction and translation exposure, revenue and cost currencies, natural hedges, sensitivity analysis, constant currency reporting, hedging assumptions, and impacts on earnings, cash flow, and leverage. Question 9. What KPIs would you monitor for JBS operations? I would balance financial and operating indicators. Core measures would include volume, realized price, product mix, yield, cost per unit, capacity utilization, downtime, labor productivity, inventory days, service levels, gross margin, EBITDA, and operating cash flow. I would tailor the dashboard by business and connect each KPI to a financial outcome. For instance, improved yield should reduce cost per saleable unit, while higher inventory days may signal working capital pressure or demand weakness. Be sure to mention volume, realized price, yield, cost per unit, capacity utilization, plant downtime, labor productivity, inventory days, service levels, gross margin, EBITDA, working capital, and safety metrics. Question 10. How would you investigate an unfavorable working capital variance? I would bridge the cash impact across receivables, inventory, and payables, then compare days metrics with budget, prior year, and operational activity. Higher inventory might reflect seasonal builds, slower demand, commodity purchases, or production planning. Receivables require aging and customer-level analysis, while payables require review of terms and payment timing. After identifying the root cause, I would recommend actions such as collections escalation, inventory reduction, purchasing changes, or supplier term discussions. Focus on receivables, inventory, payables, purchasing and production cycles, seasonality, commodity timing, overdue balances, payment terms, cash conversion, root causes, and practical remedies with assigned owners. Question 11. Describe an Excel model you would build for management reporting. I would build a driver-based model with separate input, calculation, output, and check sections. Inputs would include volumes, prices, costs, FX, and timing assumptions, while formulas would calculate revenue, margins, EBITDA, and cash flow. I would include scenario controls, balance checks, variance bridges, and clear cell formatting. To improve reliability, I would avoid hard-coding, document sources, protect formulas where appropriate, and reconcile outputs to the general ledger or reporting system. In your answer, cover clear inputs, calculations, outputs, driver-based logic, checks, scenario controls, auditability, data refreshes, documentation, and separating assumptions from formulas to reduce errors. Question 12. How would you evaluate a proposed capital investment in a processing facility? I would model only incremental cash flows, including volume growth, pricing, labor and operating savings, maintenance, working capital, taxes, project spending, and timing. I would calculate NPV and IRR using an appropriate discount rate, while also showing payback and break-even utilization because operating leaders value practical measures. Sensitivities should include construction cost, ramp-up speed, throughput, margins, and FX. I would separately discuss strategic benefits and execution risks that may not fit neatly into the valuation. Make sure to cover incremental revenue, cost savings, utilization, maintenance, working capital, taxes, depreciation, project timing, NPV, payback, sensitivities, execution risks, and strategic benefits. Question 13. What steps would you take when actual results do not reconcile to the reporting system? I would first isolate the difference by entity, account, period, currency, and reporting dimension. Then I would check completeness, duplicate records, mapping tables, sign conventions, FX rates, intercompany eliminations, and cut off. I would trace a sample back to source transactions and compare system extracts with the general ledger. I would never plug the difference without support. I would document the cause, correct the source or mapping, obtain review, and preserve an audit trail. While answering, emphasize data validation, period and entity mapping, currency and sign conventions, eliminations, duplicate or missing records, source system controls, documented investigation, escalation, and correcting root causes rather than forcing the output. Question 14. How would you present a forecast to senior management? I would lead with the headline outlook against budget and prior forecast, followed by a concise bridge explaining the largest drivers. I would highlight assumptions management can challenge, such as volume, pricing, input costs, FX, and timing. Then I would present key risks, opportunities, downside sensitivities, and recommended actions with owners. Senior leaders need a decision-oriented story, so I would move detailed schedules to an appendix and clearly state any approval or intervention required. In your answer, focus on executive-level brevity, headline outlook, variance bridge, key assumptions, risks and opportunities, scenarios, recommended actions, decision requests, and avoiding excessive spreadsheet detail. Question 15. Why do you want to join JBS as an FP&A analyst? JBS appeals to me because its global, operationally intensive businesses create meaningful FP&A challenges across volume, pricing, commodities, FX, manufacturing, and cash flow. I enjoy turning complex data into clear recommendations and partnering with stakeholders who can act on them. I would bring strong analytical discipline, Excel and reporting skills, curiosity, and attention to controls. The role would let me develop as a commercial finance partner while contributing to better forecasting, performance management, and decision-making. Be sure to connect JBS's scale and operational complexity with your interest in commercial finance. Mention analytical and stakeholder strengths, show awareness of cyclical cost drivers, and explain how you would add value and develop. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.